You can correctly predict an earnings blowout and still lose 50% of your account in seconds. This phenomenon is called the volatility crush. Before a binary event like earnings, implied volatility spikes, meaning you aren't just paying for the stock's direction. You are paying a massive premium for the market's fear. Amateurs look at this chart and try to guess the outcome, essentially flipping a coin with terrible odds. But professionals don't bet on the news itself. They sell the fear to the amateurs, banking on the uncertainty evaporating. We execute this using defined risk strategies, specifically Iron Condors. We sell the inflated options to collect premium, profiting when the volatility collapses, even if the stock price barely moves. But here is the hidden trap that bankrupts even the experts. The gap risk on binary events is mathematically infinite. If you size this like a normal trade, a single 20% gap against you wipes out months of steady profits. The solution is strict mechanical sizing. By capping binary trades at 2% total risk, you allow the statistical edge of high probability to play out without the risk of ruin. Stop gambling on the news, start trading the math.